Hi, this is Patrick Vernon from UNC Kenan-Flagler Business School. In this VCIC training video, we will discuss investing in startups. This is the core activity at a VCIC event where you, the students, will be pretending to be VCs and you'll pick one of the startups in which to make an investment. However, the most common mistake I see from teams that don't win a VCIC event is failing to put this investment in context. The investment you make at VCIC will be part of a portfolio of startups. The funding comes from a fund that you raised from LPs with a specific strategy, as we discussed in the previous video about fundraising. Part of that strategy is a hits-driven thesis that requires you to invest in high-growth startups that have the potential to return the fund. To reach that level of growth, you generally need some sort of disruptive technology. At your VCIC event, you'll be given a fund profile that will include the size of the fund, but it will be up to your team to fill in some of the blanks. Here are a couple of ways your team might break down a fund strategy. Feel free to pause the video to take notes here, or you might want to refer to the previous video to review this. I'm going to move forward with the assumption that our fund strategy is to invest an average of $10 million in each startup. This is a very important point. VCs are typically planning to invest across several rounds before exit. This means that our $10 million average needs to be spread across however many rounds we think this startup will need before exit. Hence, we only have $2 to $4 million to invest in the VCIC round, reserving another $6 to $8 million for follow-on rounds. If your team thinks a startup needs 2 more rounds after VCIC, for example, you might set it up like this. However, a $5 million investment in the VCIC round would likely not work. You would probably have a very uncomfortable partner meeting and lose the event. That is, unless you project only one more round of funding, in which case a $5 million first round would be easy to justify. That said, exceptions are the rule in venture capital, and you should not be afraid to propose an exception. You just need to understand what the exception is so that you can defend it. Understanding fund fit is one of the easiest things your team can do to increase your performance at VCIC. We will go into this in more depth in the next video, which is about growing ventures and exiting. The reality is, it's all about the exit. Today's investment is going to be predicated on what we think the exit could be and how we think we can get there. Now let's focus on activities specifically around investing. To make investments, VCs need a pipeline of deals for which they will perform due diligence and ultimately put down a term sheet when they're ready to make an investment. At VCIC, we provide the pipeline. But I do want to take a minute here to talk about how venture capitalists find deals. Your ability to thrive as a venture capitalist depends heavily on your ability to rally people around yourself. All aspects of the VC job cycle require help from others. Building and maintaining these networks is perhaps the most important core competency of a venture capitalist. And it is through these networks that VCs are always on the lookout for the next deal. VCs can often be found expanding their networks and promoting their personal brand as experts at university-sponsored events, accelerators, and conferences. Accelerators in particular have evolved into a viable pipeline for startups that may ultimately receive venture backing. Once a VC has found a startup that may be promising, it's time to begin the due diligence process. Due diligence refers to the research required to make sure the investment will be a sound one. If your team would like some help with the due diligence process, you can download some free chapters of my book, VC Razor, in which I break down the due diligence into 3 sections: market fit, industry fit, and fund fit. At a VCIC competition, there are 2 times you'll be performing due diligence. You'll receive the pitch decks 2 days prior to the event, and you'll have about 38 hours to research the industries. Note that starting in 2017, teams are now allowed to seek outside help. Once you arrive at the event, you can no longer use outside help, but you do get the opportunity to sit down one-on-one with each startup and ask the founders anything you'd like. Your team will then have to make a decision. You'll have to invest in one of the startups. You'll put down a term sheet. This is the term sheet template supplied by VCIC. In this video, we'll focus on the top 2 terms, which are the key elements of any equity investment that will determine how the equity pie will get split between founders and investors. Recall from the video in which we defined venture capital that VCs will receive new preferred shares of stock for their investment. This creates a specific challenge: pricing. VCs and founders have to agree on a price for the new shares. That price is derived from their agreeing on what the startup is worth before the investment. Let's take a look at the math. VC math is pretty straightforward algebra. You take the value of the company before the investment, you add cash from the VCs, and the startup is now worth more by the exact amount of cash that the VCs put in the startup's bank account. The theory is that the startup will take that cash and convert it into growth, thereby making the startup worth more for everybody. The terms that VCs use are pre-money valuation and post-money valuation. Note that it is the pre-money valuation that prices the round. I'm going to show you exactly how this works, and then I'm going to tell you all you really need to know for VCIC. First, a startup has to be incorporated, which means it has to have pre-existing shares of stock. To make the math easy in this example, I'm going to go with 3 million pre-existing shares. With a pre-money valuation negotiated to $3 million, that implies a $1 per share price. That is the price we use for the investment. For $2 million, we'll get 2 million shares. The result will be the venture capitalists own 2 million of a total of 5 million shares, or 40% of the equity. This is all tracked in something called a capitalization table. If you'd like to play around with the cap table, go to bit.ly/VCIC cap table to download one. A cap table can be an excellent addition to your VCIC deliverables, but it can just as easily be a distraction, as it goes into more detail than is needed at the event. All we really need to determine VC ownership is the negotiated investment amount and the negotiated pre-money valuation. We add those two together to get the post-money, and then we take the investment and divide it by the post-money for the VC ownership. The algebra here is easy. The challenge at VCIC is doing this in your head while you're on the hot seat in partner meetings or negotiations or due diligence sessions. So far, we've been looking at a 2-on-3 deal. That is a $2 million investment on a $3 million pre-money valuation. That yields 40% ownership by the VCs. But what if the founder refuses to go below $4 million for a pre-money? That would reduce your VCIC team's equity stake from 40 down to 33%. On the flip side, the judges might mention in the partner meeting that they think a $2 million pre-money valuation is more appropriate. That would result in a 50% stake. Note that we're talking about the same $2 million investment to fuel growth in this startup. It is a lower pre-money valuation that results in the higher percentage of ownership for VCs. Again, the algebra isn't difficult. The trick is having a deep understanding of how pulling one lever affects other variables. I recommend you print out or memorize a cheat sheet like this one so that you'll have easy access to this information when you're on the hot seat. By the way, if you've ever seen the show Shark Tank, you've seen this kind of equity negotiation in action, where numbers are flying around and people are trying to figure out valuations on the fly. They use the same algebra on the show, but they come at it from a different angle. Bonus question: what is incorrect about this shark's assertion of value? Pause the video if you'd like to stop and think about it. The current valuation should be the pre-money valuation, as the startup doesn't yet have $400,000 in the bank. Back to our term sheet, we've been talking about the first two terms, the pre-money valuation and the size of the investment. We're coming to a very important insight for your VCIC team. The way the term sheet is structured, you would think the percent ownership is derived from the pre-money and the investment. This is where you really need to understand the context. Remember we said it's all about the exit? Your team will need to demonstrate to the judges that you have a vision for the exit and you have some idea of the percent ownership you will need at the exit. Achieving that percent ownership at exit should be a key factor in your team's negotiating for a percent ownership in this round. You'll also need to make sure you reserve enough capital to get there. Lastly, it's got to be a fun fit. We'll continue to build on these concepts in the next training video. We'll end this session with a quote from Brad Feld of Foundry Group regarding pre-money valuation. This is Patrick Vernon. I'll see you next time.